Here to talk about the outlook is Citi's Global Wealth Chief Investment Officer David Balin and Wells Fargo CIO for Wealth and Investment, Daryl Cronk. Guys, great to have you with us. Daryl, let me start with you. A lot of hand-wringing still about potential earnings revisions and even layoffs. On the other side, Washington Post has a piece crossing this morning citing UMich, saying that consumers are finally starting to feel better about the economy in the face of receding inflation and gas prices. How are you viewing sort of the dividing lines on sentiment right now?
Yeah, I think sentiment is a really key important thing. It certainly ticked higher here on the back of gasoline prices and a little bit of food prices coming down. Although what'll be interesting is, even though in tomorrow's headline number, it will come down from probably 8.5 to somewhere around 8%, the core rate will still tick higher as rents keep moving higher. So I'm not sure the consumer is feeling quite as much happiness as maybe what some of the University of Michigan consumer sentiment data would suggest at this point.
Right. David, I assume you agree that it's certainly not going to be unlikely to be a number that by itself, even if it is good, unlikely to move the Fed, at least this month.
That's right. I mean, we're expecting that actually inflation will be down 0.3% for this month, which is a negative rate of inflation, and the 8% number reflects the rolling 12 months. Consumers are feeling a little bit better, but I think that what we're really concerned about now, looking ahead for the next 6 months, is the total impact, right, on the consumer of having rates go up 75 basis points 3 times in a row, and then whatever else the Fed does. And so the total impact of that, I think, is still yet to be felt. And I think the impact will be very significant. Right now, with employment looking like it does and being positive and continuing to grow, things are okay. But I do think we're expecting potentially next year to see between 1 million and 2 million job losses. And if that actually turns out to be the case, that will be the turning point where the Fed realizes, wait, we've had too much of an impact on the economy and too much of an impact on the consumer. And so I think there's a lot of news ahead to digest.
Daryl, the way the market has acted, in the last week or so, and then a few times before, it is as if it's trying to bring forward that moment when it seems as if it's in gear with what the Fed's going to do, and it probably doesn't have too much more tightening ahead of it. It's been disappointed, the market has, a couple of times, but at some point it probably will be correct in saying, okay, within the next 3 to 5 months, we're probably going to get to peak short-term interest rates. Would that in itself be a bullish thesis, or do we need more than that?
Yeah, I think if you can see that with clarity that far in advance, then I think that would be a bullish thesis, Mike. I think what's interesting is, and what many people don't realize, if you go back to all of the Fed meetings this year, so March, May, June, July, where we've raised interest rates, every single one of those were interpreted by the market as being dovish. And every single time the market rallied off of those meetings, only to end up being a bear market rally that failed into resistance, ended up at a lower point at some point in the future. The reality is, if you take Fed funds futures today at 4%, which is where they are this morning, any rate hike cycle has always had the 2-year above the Fed funds future. That means the 2 years got to go from a 353 probably somewhere north of 4%, which I don't think is priced into the market today, and I think can be quite hard on equity prices from here as they have to adjust to that.